Nilesh, I'll come to you first. What did you make? A lukewarm reaction that the markets have given, and possibly that's what the FM has done per se, because not too many big bang reforms. Maybe the optimist would say that it was meant to be a statement of accounts, and that's what it's remained at. But even there are a few glitches, because a few people would be disappointed with, one, the subsidy number that has come about, and two, the fact that the expenditure has not really gone down. So there will be doubts over whether they can meet this target as well.
One thing we need to remember, that when we are talking about 5.1% deficit for India, it should be also viewed in the context of where other countries' deficits are. US, UK, Japan, Europe, they are all running at 7, 8, 9, 10%. So we are in a world where higher deficit is prevailing, and probably in that context we have to look at 5.1. 5.1 in isolation may look bad, but in relative terms it's fantastic. Second thing, in terms of market development, a lot of steps have been taken in the budget which will have long-term positive effect. One is the introduction of FRBM. FRBM kind of had moved away from the center. Now it is right back in the center. The fiscal deficit target for next to next year, FY14, is at 4.5%. So clearly this is a path where, instead of making a tall, grandiose promise, we are saying that we will go this way. A couple of steps on the market side in terms of reduction in STT, allowing equity saving schemes for retail investors with tax incentives, making QFI investments in corporate bond market, opening up IPO process in electronic format. These are all steps which will eventually help market in the long term. So probably what we will see is a fair amount of volatility in the market, where pessimists will get disappointed by lack of short-term trigger, and optimists may get convinced by the long-term steps taken by the budget, and will probably continue to see fair amount of volatility in the market.
One important aspect that the bond markets are reacting to right now, you're seeing it in the yields, is the gross borrowing figure, which has been pegged at 5.7 lakh crores for FY13 from 5.1 lakh crores for FY12 that was laid out. That, of course, is playing up and is expected to play up on the yields?
Definitely. From November 2011 onwards, the bond market was kind of seeing 12,000 crore worth of OMO every week, along with 15,000 crore of auction. From 1st April, OMOs probably will not be there. Without the open market operation support from the RBI, this borrowing program will probably be unnerving the market, and which is what is reflected in the increase in the interest rates right now. Clearly, if this borrowing program has to go through, it will require some support from RBI. And looking at the condition of money supply growth and reserve money growth, which either could be facilitated by the FX intervention or by the open market operation, market has an expectation that there will be some announcement from RBI in terms of open market operation. Last year OMOs came in November 2000 onwards. Can this year it happen earlier? That will determine the kind of movement in interest rates yield.
And you expect yields in the near term or in the medium term to rise up to and perhaps even cross 9%?
It all depends upon when does RBI intervene. If RBI gives clarity on the quantum of open market operations to support the reserve money and money supply creation, as well as take away the pressure from the borrowing program, then certainly yields can remain subdued. But if that clarity is not coming, or it comes only after yields have moved up, then certainly yields will be on the way up rather than way down.
Essentially, the bigger damage to banking probably was done yesterday, after the hopes of key policy rates coming in yesterday itself were dashed, and the bank nifty duly reacted. How do you look at banks now, considering all that's happened, considering how the yields or the bonds would shape up as well? How do you view the banking pack, say, over the next 3 to 6 months?
I think banks have benefited from the budget. There are certain long-term things in the budget which will help banking sector. One is the message of financial inclusion. We have about far number of lower subscribers who are to bank than to telecom companies. And telecom companies have virtually started in the early 90s. So clearly financial inclusion will help banks to spread their tenets. Second thing is the exemption up to 10,000 rupees by virtue of savings bank interest rate. Again, this will enhance the post-tax yield to investors and help in spreading this financial inclusion. The third thing is import duty on gold. A lot of our savings are going towards physical assets like gold, which is in some sense unproductive. Now banks, if they have to go towards financial inclusion, they will be far more aggressive in going towards that if they know that there is a pot which is not going to go to gold but is going to come to financial system. So all these things will probably deepen Indian financial sector quite well, and banks will be the biggest beneficiary. The second thing which is very positive for banks is the steps taken on the infrastructure side. There has been doubts about the performance of infrastructure sector and availability of ECB financing, providing, or removing the step-down subsidiary dividends. All those things will help infrastructure much better. So that stress which was coming onto the banking sector, more in the perception of investors, will also kind of get reduced. Against these positives, obviously banks will have to worry about the increase in interest rates which is being reflected in government's yield right now. But again, if RBI cuts policy rates over a period of time, then hopefully that will be kind of not so negative factor for the banking sector. So overall banking sector as a whole will benefit from the budget.
Nilesh, what about infrastructure funding and the kind of incentives that the finance minister laid out over there, accessibility through the ECB route, also some benefits for the airline sector, opening up the market really for them to access funds. What do you make of all of those announcements?
In some sense, in infrastructure we have two issues. One is related to execution, other is related to availability of finance. In the past, even though interest rates were high and liquidity was tight, I don't think so infrastructure was getting constrained by availability of finance. And notwithstanding that, now by opening up ECB windows, by enhancing tax-free bonds for infrastructure sector, by allowing more amount of flows to come through the capital markets, or by virtue of QFI coming to corporate bond market, all these things will increase the availability of finance. And any fear which people may have because of the larger government borrowing program on the gross side probably will be negated by this. The crucial question now will be on the execution side. Can we push infrastructure sector on execution side? That is the million-dollar question, and obviously for that answer is not in the budget, it is outside of budget.
And we certainly hope that it does happen sooner rather than later, Nilesh.
I think it will happen sooner rather than later.
Great. Really nice having you. Thanks for dropping by, Nilesh. And you have a good next 12 months until the next one. Thanks so much for dropping by.